think to sort of summarize, right? Probably to start off with, it's better to have at least 40 to 60% in mutual funds and maybe 10 to 20% in direct stocks. And then you can see about your real estate and gold basis your emotions and other things, right? But this is the overall recommendation to start off with, right? Now, to invest in mutual funds, or one of the biggest ways that everybody talks about is SIPs, right? Rather than doing a one-time payment in mutual funds. Um, can you sort of explain why SIPs are recommended in general more rather than one-time investments for wealth creation?
There are multiple reasons for it. So first is going back to what we said a few minutes ago in terms of the regularity and the discipline, which is the habit of investing. SIP is a habit. So once you start an SIP, it goes on its own, it functions on its own, right? So because it's a key part of this habit, which is a critical part of your investment choice. That's number one. Number two, there is something called as the eighth wonder of the world, which is the power of compounding, right? So any simple Excel sheet will show you that if something is going to grow and you put it in, it keeps compounding, compounding. So SIP, by putting it in every month, makes that power of compounding work for you, right? Very simple. That's the second. The third part is an interesting concept called rupee cost averaging. Now, it's a word sounds complicated. All it says is that my end goal, right, is that I have to want a bigger corpus, correct? Now, in a market where the price is not constant every month, so you take equivalent product to compare would be a recurring deposit in a bank. So bank says I give you 7%, you give me money every month, it will compound at 7%, and you'll get a corpus at the end of your uh, 10 year, 5 year, 15 year, whatever time frame. Now, what is happening is every month's installment of the recurring deposit is giving you 7%.
Right.
Because it's flat and is stable and the bank has committed to you. But in the stock market, the price every month that you buy those stocks, which is the fund manager buys, you put an SIP in a mutual fund, the mutual fund buys stocks. That price varies by the minute, not even daily. It varies by the minute and by the second, correct? So
Yeah.
when the fund manager got your money in the first month, he bought a set of stocks at a particular price. But next month, God knows whether that price is going to be higher or lower, correct? So if
Yeah.
the price is higher, then for the same rupee, you got less number of shares.
Yeah.
Right? And what the price is lower, you got more number of shares. Now, ultimately, if you believe that in the long run, that share price is going to compound up, the more cheaper dates that you buy, the better for you.